Top 5 investment quotes every investor should know. Quotes have the power to leave an impact. They can also tell a story. The financial greats, from John Maynard Keynes to Warren Buffett, offer ideas that frequently endure for decades. They have experienced numerous market cycles, and their comprehension of the market is the key to their success. 1. The most important quality for an investor is temperament, not intellect. Warren Buffett, CEO of Berkshire Hathaway. Emotions frequently affect trading behavior. Think about how much more trading there was among investors in the first quarter of 2020 compared to 2009. The following 3 fear triggers may cause these trade spikes. Volatility. Greater worry is indicated by a higher CBOE volatility index reading. A stock's price strength. Higher fear is indicated by more equities hitting 52-week lows than 52-week highs. Performance of bonds and stocks. Bond outperformance may be a sign of increased fear. The S&P 500 has ultimately shown resilience in the face of tremendous investor concern. In 32 of the last 42 years, the index has performed well. 2. The individual investor should act consistently as an investor and not as a speculator. Benjamin Graham, author of The Intelligent Investor. The father of value investing, Benjamin Graham, had a significant impact on Warren Buffett. One of his many fundamental ideas is the distinction between an investor and a speculator. Investor, emphasis on prudent return and principal safety. Speculator, potentially at risk of losing the entire investment. According to Graham, consider an investment to be similar to having a portion of ownership in a company rather than simply viewing it as a ticker symbol. Investors that approach investments from the perspective of an owner seek out a company's long-term intrinsic value, which has the potential to increase in value over time. 3. The biggest risk of all is not taking one. Mellody Hobson, co-CEO of Ariel Investments, became president at just 31. Ariel currently looks after assets worth over $18 billion. Hobson understood the importance of taking the first step. 4. Time in the market beats timing the market. Ken Fisher, founder of Fisher Investments. An investor would have only received a small portion of the overall profits if they had attempted to time the market, and had missed the best performing days throughout the past century. Almost the course of each decade, staying invested produced returns of almost 17,000%, whereas skipping the 10 best days produced returns of just 28%. Opportunity can be readily overlooked because historically, the largest market declines frequently occur immediately before the biggest upswings. Even the most successful investors occasionally struggle to time the market. 5. It is better to be roughly right than precisely wrong. John Maynard Keynes, father of modern macroeconomics. Diversification can assist investors lessen the consequences of market volatility. The downside was significantly mitigated when investors combined equities and bonds in their portfolios during a 1-year period. A mix of equities and bonds has never given a negative return over a rolling 5-year period in the past 7 decades.